This means that when you buy a stock, you should purchase it at a price lower than its intrinsic value, keeping a margin of safety. But if you don't even know how to calculate intrinsic value,
The world's most successful investor, Warren Buffett, says that the three most important words in investing are margin of safety. But what does that really mean? Simply put, whenever you invest in any asset, you should buy it at a price that's below its intrinsic value. The difference between what an asset is truly worth and the price you pay for it is called your margin of safety. But here's the real challenge. If you don't know how to calculate a company's intrinsic value, how can you know whether you're getting a good deal? That's exactly what we're going to cover in today's video. Today, I'll explain one of the most important and fascinating concepts in value investing: how to calculate the intrinsic value of a stock. Once you understand this, you'll be able to tell whether a stock is genuinely cheap or simply looks inexpensive. Don't worry if you don't have a finance background. I'll explain everything in the simplest way possible, so anyone, even a complete beginner, can easily understand it. By the end of this video, you'll be able to make smarter investment decisions, improve your long-term returns, and most importantly, avoid costly mistakes in the stock market. So let's get started. The reason investors calculate intrinsic value is because a company's market price and its actual value are two completely different things. The stock market works like a giant auction. Prices move up and down based on supply and demand, not necessarily because a company's true value has changed. With thousands of listed companies, the most popular stocks often become overpriced simply because everyone is buying them. On the other hand, many great businesses receive very little attention and remain undervalued. Those overlooked companies often present the best investment opportunities. Finding a stock's current market price is easy. A quick Google search will tell you that in seconds. But intrinsic value isn't displayed anywhere. You have to calculate it yourself. That's exactly what successful investors like Warren Buffett do. Instead of looking at the market price first, they begin by estimating what the business is actually worth. Only after calculating its intrinsic value do they compare that number with the current stock price. This approach prevents emotions and market fluctuations from influencing their decisions. To understand this concept more clearly, let's ignore the stock market for a moment and look at a simple example involving a private business. Imagine your name is Rocky and you live in a small town. There's a bakery that's been operating successfully for more than 50 years. It's located in a prime area, has a loyal customer base, and people keep coming back because they trust the quality of its products. One day, the owner, who also happens to be your close friend, tells you that he wants to sell the entire business because his children have moved abroad, and he's ready to retire. Since you have enough capital and a good understanding of finance, you ask him for the bakery's financial statements from the past 10 years. Now the real valuation process begins. Now, unlike a publicly traded company, this bakery doesn't have a market price. That means you'll have to determine its value entirely on your own. The first thing you do is examine the company's financial statements. As you go through the numbers, you notice something encouraging. The bakery has generated consistent profits year after year. Next, you do some market research. You visit the bakery, observe the business, and talk to customers. You discover that people genuinely love the products. The quality is excellent, customers trust the brand, and many of them have been returning for years. Based on all this information, you conclude that the bakery is a high-quality business and is likely to continue earning stable profits in the future. This brings us to one of the most important lessons in investing. Before looking at the price of any investment, always evaluate the quality of the business itself. Many investors spend all their time watching stock prices while ignoring the strength of the company behind those prices. Successful investors do the exact opposite. Now that you've confirmed the bakery is a great business, the next step is to estimate its intrinsic value. Let's assume the bakery earns 10 lakh rupees in profit every year. You also notice that the business doesn't require heavy reinvestment. Most of its profit turns directly into cash, which means the annual cash flow is also around 10 lakh rupees. Now ask yourself a simple question. What annual return would make this investment worthwhile? Let's say you'd be happy earning a 14% annual return. In that case, the bakery's intrinsic value can be calculated using a very simple formula. Intrinsic value equals annual cash flow divided by acquired rate of return. So the calculation becomes 10 lakh rupees divided by 0.14 equals approximately 71.4 lakh rupees. This means that if you buy the entire bakery for around 71.4 lakh rupees, you'll earn roughly a 14% annual return based on its current cash flow. But why does this formula work? Where does this number actually come from? Let's break it down. Imagine you purchase the bakery for 71.4 lakh rupees. From that day forward, every rupee of profit the business generates belongs to you. If the bakery continues producing 10 lakh rupees every year, That income represents approximately a 14% annual return on your investment. And that's exactly the return you wanted. So, based on your required rate of return, paying around 71.4 lakh rupees would be a fair price for the business. But this simple formula is actually based on a much more powerful valuation technique used by professional investors around the world. It's called the discounted cash flow, or DCF method. In the next section, we'll see why a rupee you'll receive in the future is worth less than a rupee you have today, and why understanding this concept is the foundation of value investing.
Now let's take a closer look at the discounted cash flow, or DCF method, the valuation technique that professional investors use to estimate the true worth of a business. At first, it may sound complicated, but the idea behind it is actually very simple. Think about it this way. Suppose you invest 100 rupees today and earn a 14% annual return. After 1 year, your investment grows to 114 rupees. Leave it invested for another year, and it continues to grow even more. That's the power of compounding. Discounting works in the opposite direction. Instead of asking, how much will today's money be worth in the future, we ask, how much is future money worth today? For example, if someone promises to give you 114 rupees 1 year from now and your required return is 14%, that future 114 rupees is worth only 100 rupees today. Why? Because if you already had 100 rupees today, you could invest it yourself and grow it to 114 rupees over the next year. This is known as the time value of money. Money available today is always more valuable than the same amount received in the future because today's money has the potential to earn returns such as. Imagine someone gives you two choices. Receive 100 rupees today or receive 100 rupees 1 year from now. Almost everyone would choose the money today. Even if you placed it in a basic savings account, it would earn an interest over the year. By next year, you'd have more than 100 rupees. That's why future cash must always be discounted back to its present value. Now let's return to Rocky's Bakery. Assume the bakery continues generating 10 lakh rupees in profit every year indefinitely. The 10 lakh rupees you'll receive next year isn't worth the full 10 lakh rupees today. When discounted at your required return of 14%, its present value is lower. The profit you'll receive 2 years from now is worth even less today. 3 years from now, it's worth less again. The further into the future those cash flows are, the smaller their value becomes in today's terms. This doesn't mean the business is becoming less profitable. It simply reflects the reality that money received later is less valuable than money received now. Eventually, if you project cash flows far enough into the future, say 50 or even 100 years, the present value of those distant profits becomes extremely small. When you add together the present value of every future cash flow, you arrive at the company's intrinsic value. And interestingly, you'll reach almost the same figure we calculated earlier using the simple formula, around 71.4 lakh rupees. That simple formula is actually a shortcut based on the same principle as discounted cash flow analysis. In other words, whether you use the complete DCF model or the simplified formula, you're still estimating exactly the same thing. What is the business truly worth today based on the cash it will generate in the future?
The PE ratio tells you how much you're paying for every rupee of a company's annual earnings. The formula is simple. PE ratio equals market price divided by annual earnings. Let's use our bakery example again. Earlier, we estimated the bakery's intrinsic value at approximately 71.4 lakh rupees, and we assumed it earns 10 lakh rupees every year. If we divide 71.4 lakh rupees by 10 lakh rupees, we get a PE ratio of about 7.14. What does that number actually mean? It means you're paying 7 rupees and 14 paise today for every 1 rupee of annual profit the business generates. In other words, assuming profits remain stable, it would take a little over 7 years for the business to earn back the amount you invested. Now imagine the bakery owner refuses to sell for 71.4 lakh rupees. He believes the business is worth more and asks for a higher price. As an investor, you now have two choices. You can either walk away or accept a lower return on your investment. Suppose you're willing to reduce your required annual return from 14% to 12%. Using the same valuation formula, the intrinsic value increases. 10 lakh rupees divided by 0.12 equals approximately 83.3 lakh rupees. Notice what happened. As your required return decreased, the value you were willing to pay increased. At the same time, the PE ratio also rose from 7.14 to approximately 8.3. This is why investors generally prefer businesses with lower PE ratios, provided the company's quality remains strong. A lower PE often means you're paying less for each rupee of earnings, giving you a better margin of safety and potentially higher long-term returns. However, Now let's apply everything we've learned to real-world investing. Suppose you're comparing two companies. The first has a relatively low PE ratio, while the second trades at a much higher PE. Which one should you buy? Many new investors automatically assume that the company with the higher PE must be the better business. But that's not always true. A high PE ratio simply means investors are willing to pay a premium because they expect the company's profits to grow rapidly in the future. In other words, they're paying today for earnings they believe will come tomorrow. Sometimes those expectations become reality, but many times they don't. If the company's earnings fail to grow as expected, investors who paid a very high price can end up earning disappointing returns, even if the business itself continues to perform reasonably well. That's why Warren Buffett emphasizes buying great businesses at sensible prices, rather than chasing popular stocks at any cost. Let's look at a real-world example. Imagine a company trading at a PE ratio of 34. That means investors are paying 34 rupees today for every 1 rupee of current annual earnings. This doesn't necessarily mean it's a bad company. It may be an excellent business with strong future growth. However, when expectations become too optimistic, the stock price can rise much faster than the company's actual earnings. In that situation, even if the business performs well, the investment may still produce mediocre returns because you paid too much in the beginning. That's why experienced investors don't focus only on finding great companies. They also focus on buying them at the right price. This is exactly where the concept of margin of safety becomes so important. The larger your margin of safety, the more protection you have if your assumptions turn out to be slightly wrong. Fortunately, today's investors don't always have to perform every calculation manually. There are many research platforms and stock screening tools that provide ready-made financial data, valuation metrics, and estimates to help investors make informed decisions. These tools can quickly show whether a stock appears reasonably valued, overvalued, or undervalued based on different financial indicators. However, remember this: no software, website, or stock screener can replace your own understanding. These tools are designed to support your research, not to make investment decisions for you. The best investors use technology to save time, but they always rely on independent thinking before investing their money.